Hey everyone, Anthony Venuta here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and on this episode we're going to be talking about inflation and the Bank of Canada. What's going to happen on June 7th when the Bank of Canada meets to talk about their policy rate. Stay tuned, you don't want to miss this. Early this week, we got the CPI, the Consumer Pricing Index numbers for Canada for the month of April, and they came in a little bit higher than expected. And on this episode, I want to talk a little bit more about those CPI numbers, talk a little bit about what is happening right now, and will the Bank of Canada increase policy rates in June or in July when they meet again, and what are some of the push and pull factors that we should be paying attention to, and having a little bit of a discussion on what could happen next, not only with the policy rate from the Bank of Canada, but what's happening with actual mortgage interest rates and the real estate market. So first and foremost, it's important to point out over the last several months and years as we've been talking about the Bank of Canada, their policy rate decisions, obviously it's important to pay attention to the headline number. The headline number for the month of April was 4.4%. It is up from the previous month of March from 4.3%. Now, the best way to explain this is that the Bank of Canada wants to see headline inflation come down. But what's guiding their decisions, the policies, the way that they would make a decision on whether or not to increase or decrease or hold the policy rate comes from the food and fuel and energy and obviously other factors such as wages, employment, what's happening with the economy, growth. All of these things are very, very important. But it's important to understand that core inflation guides their movement, their thought process. Headline inflation is what they want to see come down. Now, it is important to understand that as the base effect for these inflation numbers, which means, if you think about it very simplistically, over the past 12 months, those average numbers are coming down. As we start to see those higher inflation numbers like we saw in July roll off, well, inflation is going to come down. And that is a very simple way to explain what is happening. However, what's important to look at is the concept that the Bank of Canada has illustrated, right? They want to see inflation return back to its target rate of 2%. They have a buffer within this range, anywhere from 1% to 3%, but they want it at 2%. So it's easier to get inflation down from 8% to, let's say, 4.4%, but it might be more challenging or sticky to get from, let's say, 4 to 3 to 2. And the reason why this is important is because for many Canadians with variable rate mortgages, those considering that the Bank of Canada may cut rates at some point or are banking on the fact that the Bank of Canada may cut rates, well, I think you might have to hold on to that dream just a little bit longer.
There is no hint of cuts in that statement. It is far too early to be thinking about interest rate cuts.
Right, this is what the Bank of Canada has said. They're going to have higher rates for longer. And the reason that is because inflation numbers are going to get sticky. And there's no signal, to me at least, that the Bank of Canada will cut rates, even if they get to 2% immediately. Let's say we get from 4% to 3% by the end of 2023, right? And maybe we get to 2% by the latter half of 2024. Well, that doesn't mean as soon as we get to 2% that they're going to cut rates, right? They are going to need to make sure that the economy is stable. And obviously, we are talking potentially about a rate cut if a black swan event happens. Obviously, a major recession, something that would force the hand of the Bank of Canada to contemplate cutting rates in order to make sure that inflation comes back down. So they're going to be grappling with this decision. But obviously, that is a little bit further away. The Bank of Canada has made it very clear that anyone's thinking about a rate cut, it is nowhere even close on the Bank of Canada's radar at the current moment. And speaking of what's on the Bank of Canada's radar, well, obviously we are looking at those job numbers that came out for the month of April, blew expectations out of the water, around 41,000 new jobs created. Now, although this is a good piece of data for Canadians, for new to Canada individuals, that there is work available, but that means that the economy is still performing well. And unfortunately, the Bank of Canada wants to see the economy performing, not as well in order to get that inflation number back down to 2%. So that is something we've talked about as well. Obviously, wages for the first time in a long time are actually, surpassing inflation, right? So if we see wage growth over 5%, right? Yeah, I think it was around 5.2% not too long ago, but inflation's at 4.4%. Well, Canadians are earning more than the rate of inflation. And this could be a problem because the more money Canadians have access to, right, the more they're able to spend, the more they're able to put into the economy, the more they put into the economy, well, it drives up prices for goods and services. Even though goods and services have sort of come off a little bit from previous months, even at the grocery store, we saw a small downtick in those costs. But fuel being a major push for the Bank of Canada, obviously for those stats, gas prices from OPEC, what happened last month, production levels were decreased, so obviously the price of gas is going to go up. But if you recall, over the past few months, right, there was government incentives, provincial incentives to take away taxes or reduce the taxes on gas, and that is something that was definitely pushing gas prices down. Did it skew the numbers, obviously, a little bit for the gas component of the CPI, the core number? Of course. But one major thing that did uptick, and something that's very close and near and dear, is obviously the mortgage component. Shelter, mortgages, and rents have dominated the reason why these inflation numbers are elevated. As more and more Canadians feel the pressures of higher interest rates when they either renew their mortgage, whether they're going from a variable or a fixed and they're renewing, or they're in a variable or trigger rate mortgage, depending, adjustable. They've already felt a lot of these pressures coming in. So that is something that the Bank of Canada is paying very, very close attention to, because as these mortgages renew, and individuals that had a mortgage a few years ago, as they approach renewal in 2023, well, they're going to go from a low rate into a higher rate. And that is going to limit the amount of disposable income that those Canadians will have to deploy back into the economy. And by doing so, well, that obviously for the Bank of Canada means that there's going to be less pressure on spending, obviously anchoring expectations. Will Canadians be spending money today versus tomorrow? A lot of things that the Bank of Canada needs to focus on. And it goes without saying, unemployment is still relatively historically low at 5%, and that is something that the Bank of Canada will obviously be looking at as well. Now, so these are all some of the components that would sort of indicate to the Bank of Canada to maybe want to push up policy rates, bring them up, maybe remove themselves from the pause or get out of the pause and maybe up it, say 0.25%. I think that the major bumps, like those 50 and 75s that we saw over the past little while, are probably long gone, but obviously anything can happen. But I think if the Bank of Canada was to make a move, it would be probably around 0.25%, just to signal to the markets, to the economy, that the central bank means business. They don't want to be put in a position of weakness. They are going to have this very hawkish tone. Let's say, for example, even on June 7th, when they come out, they're going to be very aggressive. Maybe, they're going to hold, maybe they're going to pause, but they're going to be super aggressive with their language, basically putting their foot down as best as they can, right? And this is something that we saw happening over the last little while. And, when you think about what's happening in the US, obviously the US Federal Reserve has the pause button on their end, which means that the Bank of Canada may also, want to signal their own pause or keep their pause in check alongside or in lockstep with the US. So these are very important considerations. Now, if you think about why the Bank of Canada may want to pause or hold that pause, a couple things come to mind for me. Number one is we have a meeting on June 7th and then one again on June 12th, I believe. So there is a very tight gap in between these rate announcements, which would allow the Bank of Canada to say, okay, maybe we'll pause this time. We'll assess it again in July, because it's literally just around the corner from the next rate announcement on June 7th, right? And they're going to basically take a look at that and say what's going to happen. And if we see those numbers start to continue to uptick, maybe at that point they're going to raise, maybe they're going to try to get ahead of it and do it on June 7th and maybe hold on July 12th. Either way, I think the upside risk for a Bank of Canada bump in policy rate is greater than one of them maybe holding or cutting for sure. So there's definitely more likelihood of them bumping up the rates. And the other thing that we need to take into consideration is what's happening in the real estate market right now. When we think about the benchmark house price in Canada jumping up, we think about the average house in Canada increasing in value. Although it hasn't hit the pandemic levels where we saw this insanity, there is still a big move upwards in pricing as a result of lower inventory, a 20-year low in inventory. and we're seeing those multiples, those bidding wars, and those homes going over ask. And the Bank of Canada is fully aware of what's happening. They don't like it. They won't like it if more Canadians are trying to lever themselves up, get those mortgages. And when it comes to getting mortgages, we have seen, or there are conversation points with, let's say, RBC, who's predicting potentially a 30% run up in delinquencies over the next little while. What we have noticed is obviously delinquency rates in Canada have been historically low, for that matter, but many Canadians are finding themselves not being able to keep up with their monthly consumer debt, those credit cards, those lines of credits, maybe even car loans. Those things are starting to show signs of weakness, and this could be another reason why the Bank of Canada may want to consider hitting that pause button just for a little bit longer, against contrary belief that the Bank of Canada will need to tackle inflation, bring it down to 2%. It does need to look at the entire economy as a whole and the stability of the Canadian economy, not only when it comes to Canadians, but to the banking sector.
In addition to its price stability mandate, the bank plays a critical role in preserving and promoting the stability of the Canadian financial system. Financial system stability and price stability go hand in hand. Price stability, confidence in the value of money, is the bedrock of a stable, well-functioning financial system. And financial stability is a precondition for price stability.
If we start to see some major cracks form in the major banks here in Canada, which obviously there's been a lot of conversation about with what they're doing with the default, not the defaults, obviously considering the defaults, but considering what they're doing with variable rate mortgages, even those Canadians who are not able to keep up with their payments, obviously adding back those interest costs to the principal balance, what we call the negative amortization effect. The banks are trying their best to make sure that they can accommodate Canadians, which is definitely kicking the can down the road. So there are a lot of things that are happening right now. Do I think basically that the Bank of Canada is going to increase policy rate or hold policy rates? It's a very tough and challenging conversation. We get asked this often. And obviously we have to look at the Bank of Canada, the governing council. I don't sit on that governing council. I can make an educated guess, an assumption or prediction, which we don't like to make very often. But I do think, and I would say this, that there is a higher probability of the Bank of Canada, if they don't see these numbers aligning, something we've talked about numerous times, if we don't see them aligning, we'll definitely start to see an uptick in their policy rate, at least at 0.25%, either between June or July, depending on what happens. Obviously, we'll keep a close eye on that. If that's something that interests you and you want to stay up to date with what's happening with the Bank of Canada, we invite you to subscribe to the channel. Don't forget to like the video, leave a comment below, and if you learned something in this video, feel free to share it with someone. Before we end off, I just wanted to have a little conversation about what's happening right now with these fixed rate mortgages. As we start to see the bond market surge, we are thinking that interest rates potentially are going to go up as a result of these higher inflation numbers. As the markets react, remember, they are two different components. Variable rate mortgages operate on the Bank of Canada, the central bank's policy based more closely to the economy and other factors like we talked about. And then there's fixed rate mortgages, which are basically based on bond yields, Canadian 5 years, for example, 2 and 10, depending on what you're looking at. But this is a barometer of how fixed rate mortgages are contemplated and obviously priced. And as we look at what's happening right now, the bond market is basically making a prediction that what will happen in the next little while will obviously mean that the Bank of Canada will either cut rates or leave rates alone for longer, which obviously impacts what fixed rate mortgages are doing. And although we have seen some fixed rate mortgages come down over the past few weeks, last few months, as we start to see the bond market surging back up, we are starting to get notification that potentially fixed rate mortgages will be on their descent upwards until they readjust, or if they readjust for that matter. Obviously, it is an important conversation. So the thought process here is that if you have a mortgage, or you're looking to renew your mortgage, or you're looking to get a pre-approval because you want to get out and buy a home in this market, well, we advise that you get your pre-approval done sooner than later. It is good for 120 days, and reaching out to your mortgage professional, having this conversation with them can help keep thousands of dollars in your pocket. But we'll leave the video here, wishing everyone a great weekend and even better Friday. Have a great long weekend, and we'll see you next week.